Hi, it's good to come your way with another lesson on IFRS standards. Today we are looking at business combinations, IFRS 3. Alright, by the end of this lesson, you would have a good appreciation of the concept of business combination, the principles, and you'll be able to apply the key principles in real questions or in real life. Without wasting much time, let's get started. Alright, so I want to show you an illustration to help us to understand the concept of business combination. I believe we can all see the screen. Okay, so on the screen we have two circles. We have one red circle and one green circle. So the red circle represents parents and then the green circle represents subsidiary. Okay, this illustration reminds us of Venn diagram we did way back in school. Alright, so as you can see, the red circle intersects or cut through the green circle. Alright, so this represents that the red circle has taken a portion of the green circle. Okay, so business combination occurs when a company, okay, takes over a portion or full control over another company. Alright, so that's basically what business combination is. Alright, and we need to know how to account for this transaction. Okay, so business IFRS 3 talks about the accounting treatment of business combination. Okay, so let's look at the lesson, the agenda for today. We are looking at definition, acquisition method, fair value of net assets, goodwill, non-controlling interest. This lesson is going to be geared towards introduction of the standards. Okay, so what is business combination? According to IFRS 3, business combination is a transaction or other event in which an acquirer obtains control of one or more businesses. So, like the illustration we looked at earlier, when a parent company or when one company takes over a portion or full control of another company. Okay, so in this case, the acquirer represents the parent or the company that takes over another company. Okay, that company is called the acquirer. Okay, so let me give you a real life case. Okay, so in 2014, Fidelity Bank acquired Pro Credit Bank. Okay, and Fidelity Bank acquired 100% interest of Pro Credit Savings and Loan. And what was the reason for Fidelity acquiring Pro Credit Bank? Their reason was to take advantage of Pro Credit's processes. Okay, Pro Credit has established strong presence in the SMEs industry. So Fidelity Bank wanted to take advantage of the strong SME market that Pro Credit has created. Okay, so by taking over Pro Credit, Fidelity Bank automatically has access to the SMEs market. Okay, so the objective of the acquisition was to enable Pro Credit Ghana to transfer its strong SME processes and qualified staff to Fidelity Bank to enhance the bank's services to Ghanaian businesses. Okay, so there are a number of reasons why acquisition occurs. Okay, and in this particular case, Fidelity and Pro Credit, the reason is Fidelity wanted to benefit from the strong SME market that Pro Credit has created. Okay, so let's look at the reasons for acquisition. Alright, there are a number of reasons for acquisition. So these are some of them. Okay, one of them is maintain market position. So if you are a company and you want to maintain your market position, assuming there's strong competition in the industry, you can acquire other companies in order to be strong in the industry. Okay, another reason for acquisition is market expansion and growth. If a company want to grow, you can acquire other companies to help you grow faster. Okay, and then diversification. If you're a company, you want to enter into different industries or different markets, acquisition is one of the ways of going about it. And also to access technology and expertise. If you're a company and you don't have access to certain expertise, okay, or certain technology, by acquiring another company, you automatically have access to those technologies and expertise. So, for instance, since some years back, Facebook acquired WhatsApp, and by Facebook acquiring WhatsApp, now Facebook was able to access the technology of WhatsApp. They was able to access the technology and the expertise of WhatsApp. So there are good reasons why companies engage in acquisition. All right. Now let's look at the concept of control. You know, the word control is paramount when it comes to business combination. Okay, so what does it mean to control another entity? All right, so basically, to control another entity means to have power over the other entity. And what does it mean to have power? To have power means you have the right to make significant decisions on behalf of that company. All right, that's what it means to have power. Apart from that, you also have the right to receive returns from the company you have invested in. When any investor expect some returns from their investment. So if I invest in a company, let's say if I buy shares in MTN, in Airtel Tigo, I expect to earn some dividends. All right. So to have control also means to have the right to earn some form of returns from the subsidiary. Okay. And also to have control means you also have an ability to influence the performance of the company. That is, you can have power to change key management personnel, propose strategies that the companies should adopt, and do a number of things that can either improve the performance of the subsidiary. Okay, so that's what it means to control another entity. But in most cases, to control an entity means to have more than 50% ownership, or to have more than 50% stake in the other company. Okay, that gives you control over the entity. All right, so the standard says that once control is established, then it means you have to apply this standard, okay, for this transaction, for this acquisition. All right, so that's the definition of control. All right, let's look at the concept of fair value. Fair value is basically the market price of an asset or liabilities. Okay, so the standard says that whenever you acquire a new company, whenever there's business combination, or whenever there's acquisition, the acquirer or the parent company has to value all the assets and liabilities of the subsidiary at fair value. It means that the acquirer or the parent has to determine the market prices of all the assets and liabilities the of the subsidiary. So if, for instance, the subsidiary has assets vehicles such as vehicles, maybe furniture, computers, and what have you. Okay, all these assets has to be fair valued, all right, for the purpose of the standard, or in compliance with the standard. All right, so that's the concept of fair value. Okay, now the standard says that whenever there's acquisition and control is established, the parent has to apply the acquisition method in recognizing this transaction or in treating this transaction. Okay, so what is the acquisition method about? All right, so the acquisition method is simple. Okay, an entity shall account for each business combination by applying the acquisition method. Okay, so what are the requirements of the acquisition method? So the acquisition method says that first of all, you have to identify the acquirer, okay, which means the parents, the one that is buying or taking over the other company. Then you also need to determine the acquisition date, the dates that the acquisition occurred. Then you also have to identify all the net assets of the would-be subsidiary or the company that the parent is acquiring. So all the net assets or all the assets and liabilities. Okay, net asset is the same as assets minus liabilities. So the parent company has to identify all the net assets or of the all the assets and liabilities of the subsidiary. Then after that, the parent company has to determine or calculate goodwill. He has to determine goodwill, and we'll look at goodwill very soon. Okay, so let's look at how to recognize or identify assets and liabilities. Okay, so the standard says that the acquirer shall recognize goodwill and all the assets and liabilities, okay, of the and non-controlling interest in the acquiree. Okay, so first, we've not explained the concept of non-controlling interest, so let me quickly explain that. So non-controlling interest, let me use this diagram to explain. Okay, so as you can see, the subsidiary is this circle you can see here, and the parent has acquired this portion. Okay, now this portion is what we refer to as the non-controlling interest, also known as NCI. So the non-controlling interests are the other shareholders that that controls the other shareholders apart from the parent. Okay, they are called the non-controlling interests. Okay, so according to IFRS 3, okay, the acquirer has to determine the goodwill from the acquisition, also identify the non-controlling interest, identify all assets and liabilities, of the subsidiary. All right, so that's what that's the requirements of the standard. Okay, let's continue. Let's look at the measurements of the assets and the liabilities. So like I explained earlier, all the assets and liabilities has to be measured at their fair values. Okay, so what is the fair value? So basically, fair value is the market price of the assets. Okay, so maybe the subsidiary has a number of assets, maybe vehicles, furniture, equipment. Okay, so all of these has to be fair valued, or the parent has to find the fair values of these assets for the purpose of um, consolidation. Okay, let's continue. Let's look at the measurements of non-controlling interest. Okay, so the non-controlling interests are the other shareholders. How do we determine their value? Okay, how do we determine their value? The standard says that we can use the fair value method. We can determine their fair value. The NCI, we can determine their fair value, or we can find their proportionate share, okay, of their interest in the subsidiary. So if let's say the parent has 80% shares interest, then I mean that the value of the non-controlling interest is 20%. Okay, so there are two ways: either we use the fair value or the proportionate interest in the subsidiary. All right, so that these are the two ways of determining or valuing non-controlling interest. Okay, let's look at consideration. All right, so consideration basically is the amount that is transferred to to the to the subsidiary or to the shareholders of the subsidiary as payment for the interest that the parent has acquired. Okay, so examples of consideration can be in the form of cash, other assets, can be a business, it can be another subsidiary, it can be through contingent consideration or ordinary shares or preference shares. So there are a number of ways or there are a number of consideration that can be offered to acquire interest in a subsidiary. Okay, let's look at goodwill. Alright, so what is goodwill? Goodwill is basically, let me say, is a profit, let me say a profit or a gain after or in the transaction, a gain in the business combination transaction. All right, so according to the standard, the acquirer shall recognize goodwill as of the acquisition date, measured as the excess of A over B. Okay, and this is A. So the A is the consideration transferred, the aggregate of the consideration transfer plus the amount of the non-controlling interest, and B is the net asset of the subsidiary. Okay, so goodwill is the difference between the consideration offered plus the value of the NCI minus the net assets of the subsidiary. Okay, so this is the definition. This is the definition of goodwill: is the consideration, okay, plus the value of NCI minus the net assets of the subsidiary. Alright, so this can be positive or negative. Alright, so if it's positive, it means that the consideration and the value of the NCI is more than the net assets. So that's why we get positive goodwill. But goodwill can also be negative. So it becomes negative when the consideration plus the net asset is less the consideration plus the NCI, the value of the NCI is less than the net asset. Okay, so when goodwill is negative, okay, we call it gain on bargain purchase. Okay, we call it gain from a bargain purchase. Okay, this is where goodwill is negative, or this is where the the net asset is more than the consideration offered. Okay, so the difference, the gain from bargain purchase is treated as a gain. Okay, and the standard says it should recognize, the parents should recognize this as a gain in their financial statement. Okay, so recognizing and measuring goodwill or a gain from a bargain purchase. Okay, so this occurs where the consideration offered for the acquisition of a subsidiary is less than the net asset of the assets acquired in the subsidiary. Okay, so in this case, the acquirer shall recognize the gain in profit or loss on the acquisition date. Okay, so when the parent acquires when there's gain from a bargain purchase, okay, that gain should be treated as a gain in the parent company's financial statement. All right, so that's it for today. Thank you for watching and joining, and see you next time. All right, so you can visit our YouTube channel to go through our videos and learn a number of things from our video. Thank you.